All right. So here's another thing, and I've talked to you before, V, about this, and I always think that this is super interesting to finance guys. Okay. So on the left side, we have a company's net income statement. Okay. And they have sales of $1 million. They have expenses of 650, depreciation of 100,000. We have a net income of 250,000. That's a 25% profit margin, right?
Yeah.
Sales, net income divided by sales, right? So
Hmm.
that's where we're at, right? Over here, but let's look at the company's actual cash flow. So it's sales of 100,000. They have expenses of 600,000. Oh, but I didn't. What? Guess what? There was an equipment purchase for $1 million,
Hmm.
and
Yeah.
we needed this equipment purchase to generate these sales and therefore get this net income, right?
Hmm.
So what's our actual cash flow? 1 million minus 650 minus 1 million is negative cash flow 650,000.
Mm. Okay.
So what happens is that let's take a this note. A capital expenditure at $1 million purchase has a 10-year depreciation schedule. So that means what the IRS wants us to do is it wants us to take this $1 million, put it on the balance sheet, and then expense it $100,000 a year because of wear and tear.
Right.
Okay.
Hmm.
So that wear and tear is picked up only in the net income statement. So if you were looking at this business and you didn't see this, how nice, look like a pretty solid business to buy, right?
Yeah.
But if you don't actually look at the cash flow, you could look up and they have a big old fat minus. So that's pretty much what's happening when we look back here, where you have these big minuses of free cash flow, but you're having a profitable EBITDA and a profitable net earnings up here.
Mm.
Okay,
Yeah.
so when you guys got a financial guy on your team, you got to find one of their main jobs. One of my main jobs when I'm working for a client is I want to spot these hidden possible cash flow outlays. Okay, because the goal is if you bought this business and you ended up with a negative cash flow, you're not going to be happy, right? Your
Mm.
investors are not going to be happy. Your debt partner is not going to be happy. The goal of a business is to produce cash to pay bills, debt, and a rate of return to investors. And the investor is you. Okay.
Right.
So
Hmm.
this is my biggest, if you don't know true knowledge of accounting, buyer beware.